In most areas of life, effort leads to predictable results. Study for the exam, you pass. Practice the instrument, you improve. But the market operates under a different logic. You can execute a perfect process, follow every rule, and still lose money on the next trade. This disconnect drives beginners toward a specific trap. Because uncertainty feels dangerous, the amateur adopts the mindset of a predictor. They search the chart for absolute proof of where the market is going, hoping to remove every ounce of doubt before they act. This animated flowchart shows the result of that search. A trader waits for one more candle to be sure. By the time they enter, the move is mostly over, the risk is high, and the trade fails. Frustrated by the loss, they jump into the next trade way too early, terrified of missing the next run. Amateurs try to solve this by adding more information. They find a new indicator or a more complex strategy, believing that a lack of knowledge is the problem. But more data doesn't remove uncertainty. It often just gives the trader more things to be confused about. The chart never reveals the future. It only shows fragments of the current condition. A strong candle might have weak volume. Improving momentum might be hitting a wall of resistance. The information is always incomplete. Trading isn't the art of knowing what will happen next. It is the discipline of making decisions when you don't know what will happen next. To survive, the trader must abandon the desire to predict and learn to operate in the fog. Professionals replace prediction with qualification. Instead of asking if a trade will work, they ask a simpler question: are the current conditions clean enough to justify the risk? To answer this, they use an evidence stack. This framework forces the trader to layer observable market behaviors, stripping away personal opinion and guesswork. The first layer is structure. The trader identifies whether the market is forming a readable shape, like an upward trend, or if the price movement is too messy and disorderly to trust. Next, they stack momentum. They look for energy and conviction behind the move. When momentum is strong, candles expand and pullbacks stay shallow, suggesting the current direction has real force behind it. Then they check volatility. A market that isn't moving doesn't offer opportunity. The trader needs to see enough range to justify placing capital at risk, ensuring the move has room to breathe. "I feel like it's going to bounce here," is an opinion. Price is holding structure, momentum is expanding, and volatility supports the range, is a decision process. One is an argument with the chart, the other is a response to evidence. The evidence stack doesn't guarantee a win, but it protects the trader. It prevents becoming loyal to an idea the market is clearly not supporting. Even with an aligned stack, the outcome of any single trade is random. A sudden reversal or a news event can break the best setup in seconds. This makes strict risk boundaries a requirement, not an option. Risk management is a direct acknowledgement of the market's scale. It acts as a hard boundary for the ego, ensuring that when the market moves against a position, the exit is dictated by logic rather than hope. Position sizing is a psychological tool as much as a financial one. On the left, a small position allows for calm observation. On the right, an oversized position hijacks the nervous system, making every small price tick feel like a personal threat. When the size is too large, you stop trading the chart and start trading your own stress. A normal pullback becomes unbearable, forcing a panicked exit before the trade ever has a chance to work. Professionals define the invalidation point, the exact spot where the idea is proven wrong before they enter. This removes the need for emotional bargaining once the trade is live. Controlling risk protects your capital, but more importantly, it protects your clarity. A trader who loses too much on one trade rarely has the composure to execute the next one correctly. After a trade closes, the amateur's first instinct is to look at the profit or loss. They judge their intelligence by the outcome, assuming a win means they did the right thing. This matrix shows why that logic is dangerous. In a probability game, you have to separate decision quality from outcome quality. A professional cares about the process. The amateur only cares about the result. A normal failure is a good decision with a bad outcome. The setup was valid and the risk was controlled, but the market didn't cooperate. These are a standard cost of doing business. They require no apology and no changes to the plan. The most dangerous scenario is a bad decision with a good outcome. You broke your rules and made money anyway. This rewards the very behavior that eventually leads to a catastrophic loss. It teaches you that discipline is optional. When a trader finally accepts that they cannot control the outcome, they find a strange sense of calm. The adrenaline and drama fade away. The work is no longer about catching every move, but about executing the framework with clinical consistency. The market is indifferent to your opinions. Your only real edge is the ability to make quality decisions in the face of uncertainty, manage your risk honestly, and stay clear enough to take the next opportunity.